Hey everyone, welcome back to Corporate Dakota. Today, Port Street Quality Growth Fund just filed its annual shareholder report, and I'm seeing performance numbers that tell a story about value versus growth. Quick note, this is not financial advice, just my take on public filings for educational purposes. While the fund's performance lagged its benchmark, its core investment philosophy is clear and consistent. Alright, let's dive into what is happening with the Port Street Quality Growth Fund. This is their certified shareholder report, basically their yearly check-in for the period ending the 31st of March. 2026, the fund's name itself, Quality Growth Fund, tells you a lot about its aims. They are looking for companies that are good quality businesses and have potential for growth. First off, let's talk about costs because that directly impacts your returns for a hypothetical $10,000 investment in their institutional class. The total costs were $101 for the year. That is about 0.97% of that investment. It is not a huge number, but it is good to keep track of these fees. They're a small drag on performance, and over long periods they can add up. Now the big question, how did the fund actually perform, and what made it perform that way? For the 12 months ending the 31st of March 2026, the Port Street Quality Growth Fund returned 7.83%. That might sound okay on its own, but then you look at its benchmark, the S&P 500, which returned a much stronger 17.80%, so the fund significantly underperformed the broader market. The report explains this by saying their investment approach, which focuses on traditional long-term discount rates when evaluating businesses, can lead to underperformance during times when the market is focused on high valuations. They also highlighted a sizable cash position they held, and a limited exposure to certain booming areas like artificial intelligence-related companies. This cautious approach is what the fund calls its valuation discipline and risk awareness. It means they're prioritizing buying businesses they believe are undervalued based on their intrinsic worth, which often involves consistent profitability, strong finances, and solid management. Let's look at the longer-term performance. Over the past 5 years, the institutional class returned an average of 5.48% annually, while the S&P 500 averaged 12.06%. Over 10 years, the Port Street Quality Growth Fund showed an average annual return of 7.14%, but the S&P 500 nearly doubled that at 14.16%. This highlights a consistent pattern of underperformance against the S&P 500 over longer periods as well, which really emphasizes their distinct investment style. As of the 31st of March 2026, the fund had total net assets of about $164.5 million. They held 26 different investments, which is pretty concentrated. The net advisory fee was $1.26 million. Portfolio turnover was a very low 9%, meaning they weren't actively buying and selling a lot of stocks within the year. This low turnover aligns with their long-term investment philosophy. Now, what were they actually invested in? The biggest holding by a significant margin was United States Treasury bills, accounting for 39.9% of their net assets. This is a very conservative position, suggesting a defensive strategy or a belief that cash is king in the current market. Following that, they had holdings in, well, known companies like Alphabet, Berkshire Hathaway, Microsoft, Medtronic, Novo Nordisk, Walt Disney, Unilever, General Dynamics, and ASML Holding. These are mostly large, established companies. Looking at sectors, US government-issued securities are at the top with almost 40%, again showing that conservative stance. Healthcare makes up 14.2%, information technology 10.2%, communication services 9.2%, and industrial 7.8%. So, while they hold tech and communication companies, their largest sector allocation is in government securities, which is not typical for a fund labeled quality growth. Diving into the financial statements, specifically the schedule of investments, we can see how these top holdings are valued. For example, Alphabet Inc. class of shares were valued at $9,285,888. Walt Disney Company was valued at $5,767,861. Across all common stocks, which made up 58.8% of the fund's assets, they had a total value of $96,679,933. And for those US Treasury bills, the total value was $65,649,353. Looking at the statement of assets and liabilities as of the 31st of March 2026, the total assets were over $164.8 million. On the liability side, they had various payables, including to their advisor for capital shares redeemed and for administrative fees. Total liabilities were around $322,000. This left them with net assets of $164,508,195. The net asset value per S-share for the institutional class was $15.99. The statement of operations for the year ended the 31st of March 2026 shows interesting figures for investment income. They earned about $2 million in dividend income and over $2.5 million in interest income, which makes sense given their large holding in treasury bills. Total investment income was $4,481,662. On the expense side, the investment advisory fee was the largest chunk at over $1.5 million. Other expenses included fund administration, shareholder servicing, and audit fees. Total expenses before a reimbursement from the advisor were around $2 million. The advisor reimbursed $239,501, bringing the net expenses to roughly $1.76 million. This resulted in a net investment income of nearly $2.7 million. Now, let's look at gains. They had a net realized gain from investments of over $22.4 million. However, there was a net change in unrealized appreciation, meaning the value of their holdings decreased overall by a little over $10.5 million. So, the total net realized and unrealized gain was about $11.9 million. All of this led to a net increase in net assets from operations of about $14.6 million for the year. The statements of changes in net assets show that for the year ended the 31st of March 2026, the fund had a net increase of about $14.6 million from operations. However, they distributed over $23.8 million to shareholders. This means that capital transactions, which include shares sold and redeemed, actually led to a net decrease in assets. Overall, the net decrease in net assets for the year was about $21 million, bringing the total net assets down from over $185.5 million at the start of the year to $164.5 million at the end. Looking at the financial highlights for the institutional class, the total return for the year ended the 31st of March 2026 was 7.83%. Matching what we saw earlier, the ratio of expenses to average net assets after reimbursements was 0.97%, confirming the cost for investors. The portfolio turnover rate remained very low at 9%. Now, let's skim through the notes to the financial statements. These notes provide important details about the fund's operations. The fund is organized as a series within the Managed Portfolio Series Trust. They follow accounting principles generally accepted in the United States. A key part of accounting for investments is how they value them. They use fair value based on observable inputs when possible. Level 1 inputs are unadjusted quoted prices in active markets. Level 2 inputs are observable but not necessarily quoted prices, like yields or broker quotes. Level 3 uses unobservable inputs when market data isn't available. For their assets, common stocks are primarily valued using level 1 inputs, meaning they are actively traded and their prices are readily available. Short-term investments like US Treasury bills are often valued using level 2 inputs, which rely on market observable data. This section details the agreement with their investment advisor, Port Street Investments LLC. The advisory fee is tiered, starting at 0.85% on the first $100 million of assets and decreasing for larger asset levels. Importantly, Port Street has a contract to waive fees and pay expenses to ensure total annual operating expenses do not exceed 0.97% of the fund's net assets. This is a crucial expense cap that protects investors from rising costs. They also mention the sub-advisor, Saratoga Research and Investment Management, which handles the day-to-day portfolio management. The fund also pays shareholder servicing fees, capped at a maximum annual rate of 0.10% for the institutional class. These fees help intermediaries provide services to shareholders. Looking at federal tax information, the fund had a net unrealized appreciation of $37.3 million. This means that the value of their unrealized gains on investments was significantly higher than their unrealized losses. The total cost of their securities was over $124 million. The components of distributable earnings on a tax basis show a healthy amount of undistributed long-term capital gains and net unrealized appreciation. Finally, the report includes the opinion of their independent registered public accounting firm, Cohen & Company. Limited, they state that the financial statements present fairly, in all material respects, the financial position and results of the fund. They've been the fund's auditor since 2014. So, what is my take on Port Street Quality Growth Fund's filing? The story here is one of consistent adherence to a value-oriented, risk-aware investment strategy. They are clearly not chasing market fads, opting instead for what they see as undervalued businesses with strong fundamentals. This is evident in their high cash position and low turnover. The downside, as seen this past year and over multiple years, is significant underperformance compared to broader market benchmarks like the S&P 500. The biggest risk I see for this fund is that its cautious approach might mean it misses out on significant market upswings, while the focus on quality and value can be a good defensive strategy in volatile markets. It can also lead to prolonged periods of what might seem like underperformance to investors looking for growth. The expense cap at 0.97% is a strong positive as it limits the drag of fees. However, the question for investors is whether this consistent underperformance against the market is a price they are willing to pay for the fund's specific risk management philosophy. What I am actually looking for is whether the fund's stated goal of total return can be achieved over the very long term despite its current underperformance. The gap between its returns and the S&P 500 is substantial and has persisted. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you appreciated this breakdown, please like this video and subscribe for more deep dives into corporate filings, and join the discussion in our Discord community. Linked in the description.